Welcome to the Pro Ticker Deep Dive.
Great to be here. Today, we're really digging into a sector that's just dominated everything for the last couple of years, semiconductors.
It really has. And it's in such a strange spot, isn't it? There's this paradox.
Mm-hmm.
On one side, you have the engine driving the AI revolution. It's the crown jewel, no doubt, of this bull market. We're talking multi-trillion-dollar market caps.
Absolutely huge.
But then, on the other side,
Hmm.
the very physics, the science that fueled all that incredible growth for, 50, 60 years, it seems to be slowing down, hitting some walls.
That's exactly the tension.
Yeah.
That's what we need to unpack in this deep dive. How do these sky-high valuations, what we're calling this Moore's Law premium, how does that square with the reality?
The reality of physics catching up and costs just soaring.
Precisely. The premium seems to be, well, let's say, conveniently ignoring some pretty significant physical limits and, frankly, staggering financial costs that everyone in the industry is facing.
Okay, before we get into the why, let's just ground ourselves in the scale here.
Mhm.
Because the numbers, they really are kind of mind-blowing.
They are. The whole semiconductor ecosystem globally, designers, the foundries making the chips, the equipment guys, it's valued at roughly $6.5 trillion right now.
6.5 trillion. And that's more than tripled in just the last year and a half.
More than tripled, yeah. And leading the charge, of course, is NVIDIA. Just NVIDIA alone, market cap of $4.8 trillion.
4.8. Almost 5 trillion for one company.
And when you look at the financials underneath that, I mean, the pricing just jumps out at you. Forward price to earnings multiples, we're seeing numbers like 56x all the way up to 128x.
Wow, okay, those aren't just like growth numbers. Those sound more like...
Moonshots.
Yeah,
Exactly. Those are moonshot multiples. They imply, decades of absolutely perfect growth and execution. No hiccups allowed.
So, okay, why? Why is the market paying that? Let's start with a bull case, because you have to admit, this AI supercycle story is powerful. It's compelling.
Oh, it absolutely is. You can't deny the demand story. Data center spending, it's accelerating everywhere faster than we've ever seen.
Because Gen AI just needs so much more compute power,
Yeah.
right, than anything before.
Exponentially more. And this isn't just theory, we're seeing real commitments.
Like the OpenAI number.
Exactly. OpenAI has publicly said they're committing over $1.1 trillion to infrastructure. That's between now, 2025 and 2035.
1.1 trillion. That kind of number basically guarantees massive demand for a decade, doesn't it? It underpins the whole sector.
That's the bet. And you see that money flowing. NVIDIA's growth, staggering isn't even the word. AMD, they landed that huge $90 billion hardware deal with OpenAI.
Right.
And even Broadcom, they're locking in these big custom silicon orders from the hyperscalers, Google, Meta, Anthropic. They all need specialized chips. So the market sees this, and it looks like an unstoppable success story.
It does sound compelling. But is there anything, like, historically that suggests that kind of spending guarantees smooth sailing for 10 years straight? Because you mentioned fragility earlier.
Exactly. That's the key word, fragility. To really understand why this boom might be more fragile than it looks, we have to talk about the physics, the actual science.
Go.
This whole financial house of cards, it's built on an assumption, the assumption that performance just keeps improving like it always has. But that improvement, that was driven by Moore's Law.
Moore's Law, the miracle, right. Transistor density doubling roughly every 2 years, chips getting better, faster, cheaper, reliably.
That was the miracle, yeah. And, that miracle is fading, seriously fading. The first big crack really showed up around 2005, maybe 2007. That's when Dennard scaling failed.
Dennard scaling. Okay, refresh our memory.
Right.
Why was that so important? What did its failure mean?
Right. So Dennard scaling was kind of the quiet partner to Moore's Law. Everyone knew Moore's Law, but Dennard scaling was just as critical. It basically said that as transistors got smaller, the voltage they needed also shrank proportionally.
Okay, so power density stayed constant.
Exactly. You could pack more transistors in the same area without the chip becoming, a furnace. But when Dennard scaling broke down in the mid-2000s, boom, physics hit hard.
Your chips got hot, really hot.
Super hot and inefficient. Suddenly we ran into big problems with things like electron tunneling, basically current leaking where it shouldn't, and just managing the heat dissipation became a nightmare.
So you're wasting power, leakage power, right?
Tons of it. And that meant making transistors smaller didn't automatically give you better performance per watt anymore. Sometimes it actually made things worse from an efficiency standpoint.
Okay. So smaller didn't always mean better or more efficient after that point.
Precisely. And that's why that whole transition from, say, the 22 nanometer node down to 14 nanometers,
All right.
that became this really difficult multi-year struggle.
I remember that taking longer than expected.
It did. The main challenge wasn't just geometry fitting things closer, it was managing the power and heat. So the pace, that reliable 2-year doubling, it slowed. It became more like 2.5, even 3 years to get the real benefits of the next process node.
So the performance improvements are getting harder and slower to achieve?
Yeah.
But I bet the cost didn't slow down.
Quite the opposite. The costs are exploding. That's where Rock's law comes in, sometimes called Moore's second law.
Rock's law.
Yeah. It observes that the cost to build a cutting-edge semiconductor factory, a fab, it roughly doubles every 4 years.
Every 4 years.
Yeah.
Doubling.
Yeah.
That just sounds unsustainable. We're talking what kind of numbers now for a new fab?
We're talking $20 billion just to build one state-of-the-art facility today.
$20 billion. Forget the Silicon Valley garage startup. This is like nation-state level investment.
It really is. And the machines inside, astronomical. Those EUV lithography machines, the extreme ultraviolet ones you need for the bleeding edge, they cost $300 million each.
$300 million for one machine tool.
Yep. And then add the cost just to design a complex chip these days. That's hundreds of millions too. So you see the picture. The physics are slowing the performance gains, but the price tag just to get those smaller gains, it's soaring.
Okay, this brings us right back to that central question. Physics slowing, costs exploding. So why are these companies trading at 56x, 90x, even 128x forward earnings? It feels like the market's pricing in a return to the good old days of easy scaling.
That's exactly what the Moore's Law premium is. We can actually put numbers on it. If you look back at previous big tech booms like the dot-com era for chips or the last major cycle, the leading semiconductor companies usually trade at maybe 25x to 40x forward earnings. Robust, but, grounded in some reality.
Right, 25 to 40x sounds like a healthy growth multiple.
It is. So the current 56x to 128x range, that extra chunk, that additional 16x to, 88x of multiple on top of the historical norm, that's the premium. It's value the market is assigning based purely on the assumption that the historical exponential scaling somehow continues, despite all the physical evidence we just talked about.
And this premium, it must depend on some pretty big assumptions holding true.
Oh, absolutely. It rests on 4, I'd say, very vulnerable, very interconnected assumptions. The market is basically pricing these in as near certainties. If any one of them breaks, the premium is at risk.
Okay, let's break down these 4 pillars holding up these valuations. What's the first one?
First is perpetual high growth. Simple as that. The market is assuming that data center spending, the CapEx, will just keep doubling or tripling every few years for the next 5, maybe 10 years straight.
Which has basically never happened before in any previous tech cycle, right?
Yeah.
There are always pauses, corrections.
Always. But the current pricing says, nope, this time is different. Uninterrupted exponential growth. That's assumption 1.
Okay. What's assumption number 2?
Unlimited market expansion. This is the idea that AI isn't just another cycle. It's creating this entirely new universe of compute demand that will absolutely dwarf everything that came before, combined.
Plausible? Maybe, but definitely not proven yet.
Not proven. And importantly, the adoption of what you might call agentic AI, the kind of AI that acts autonomously and needs huge amounts of inference compute power, that seems to be happening a bit slower than some of the really bullish forecasts expected.
Okay, assumption 3 must be about competition.
It is. Sustained competitive leadership. This assumes the big players, your NVIDIAs, your AMDs, will keep their huge market share and, critically, their pricing power.
Even with rivals getting better and their own customers starting to compete.
Exactly. Those are the 2 big threats. Direct competition heating up, and the hyperscalers designing their own chips specifically to reduce reliance on the leaders. Assumption 3 says the leaders fend all that off indefinitely.
And the final pillar, the one holding it all up.
This is maybe the most fragile one. Perfect execution. The market is essentially betting on 0 surprises.
0.
0. No delays in manufacturing, no bugs in chip designs, no geopolitical shocks like something happening with TSMC in Taiwan, and crucially, no economic recession that hammers corporate IT spending.
Wow. So perpetual growth, unlimited market, sustained leadership, and perfect execution. That's a lot to assume.
As everything has to go right all the time for years, if just one of those assumptions proves wrong, that Moore's Law premium could evaporate very, very quickly.
That does sound like a fragile foundation.
Yeah.
And if we look at what the market's actually doing, the technical action right now in November 2025, are there signs that maybe some investors are getting nervous seeing these risks?
I think there are, yeah. You see some divergences. Take NVIDIA, still the giant $4.8 trillion market cap, trading at that 56.55x forward PE.
Okay, 56 times earnings.
Now think about what that multiple implies. If you flip it, 1 divided by 56, you get about 1.8%. That's the implied cash-on-cash earnings yield you get for owning the stock right now.
1.8%.
Yeah.
Less than a treasury bond, right? It tells you the entire value proposition is future growth, not current earnings power.
Entirely. To make that 566 multiple work mathematically, consensus estimates need NVIDIA's earnings to grow somewhere in the high 20% range every year for decades.
Decades of high 20% growth.
Okay. Yet despite being the leader, NVIDIA stock only gained about 5.7% over the past month. The S&P 500 did better, up around 8%. That underperformance, it suggests maybe some profit-taking, some distribution by informed money.
Interesting. Now, contrast that with AMD. That's the real high flyer, right? Trading at, what was it, 128 times forward earnings?
128.41, yeah. Astronomical. AMD really represents the pure hope, the speculative bet in this space. It's all about that OpenAI deal excitement.
And the analyst projections are just massive for them.
Huge. Some analysts are modeling earnings per share hitting $18 by 2030, which requires them grabbing significant market share very quickly. And reflecting that hope, AMD stock was up almost 13% in the past month.
So AMD is pure future bet. If they hit any snags, any delays, shipping their next big chip, the MI400.
There's absolutely no cushion in that stock price. Zero margin for error at 128 times earnings. It has nowhere to hide if execution isn't flawless.
Okay, one more. Broadcom. They're different, more network-focused, right?
Yeah.
Huge backlog, but also a high multiple, around 91x.
91.66, yeah. They've got a massive $100 billion revenue backlog, mostly in networking silicon for data centers. Very strong position. But look at the stock last month, basically flat, up less than 0.5%.
Flat performance with a $100 billion backlog. That screams caution, doesn't it? Or maybe quiet selling.
It suggests informed investors might be taking profits or reducing exposure, yes. Because the risk for Broadcom, even with that backlog, is clear if that overall data center capex growth just slows down a bit.
Which history suggests it eventually will.
Right. If it slows, Broadcom's own growth rates could compress pretty quickly, maybe down to single digits within 2 or 3 years. And if that happens, a 91x multiple is completely unsustainable. You risk what we call a catastrophic re-rating.
A re-rating meaning the market just slashes the PE multiple it's willing to pay, regardless of current earnings, back towards, say, 30x.
Exactly. That kind of multiple compression from 91x down to, say, 30x or 40x, that would be incredibly painful for shareholders, even if the company itself is still growing modestly.
Okay, we've laid out the physics, the costs, the assumptions, the valuations. It feels like the fragility is very real. Yeah. Let's try to pull together the key elements of the bear case. What are the biggest risks you see right now?
Well, the bear case doesn't need nearly as many heroic assumptions, which is usually a good sign. First, you've got what might be the canary in the coal mine inventory.
Seeing signs of buildup.
We are. TSMC, the biggest foundry in the world. They just reported their October numbers. Slowest monthly revenue growth they've seen since early 2024, only up about 17% year over year.
Which sounds good in isolation, but relative to expectations.
Relative to recent trends and expectations, it suggests caution. It suggests their customers, the chip designers, might be getting worried about holding too much inventory. That's often the very first sign of a slowdown.
Okay, inventory watch. What else? Talk about costs.
Right, the capital intensity. It's biting hard. These chip companies are now spending 15, even 16% of their revenue on capital expenditures. Building fabs, buying those EUV machines.
And historically, that was lower.
Historically, it was more like 10 to 13%. When you have to spend more and more capital just to stay competitive, just to get those incremental performance gains, it directly eats into your return on invested capital, your ROIC. That makes the business fundamentally less profitable over the long run.
Makes sense. And the competition. Not just AMD versus NVIDIA, but the customers.
That's a huge one. Google with their TPUs, Meta designing custom silicon. Amazon has their own chips too. This trend of hyperscalers designing their own specialized chips, their ASICs, it's a direct assault on the pricing power of the leaders like NVIDIA.
Because they want to be less dependent and maybe get something cheaper, better suited.
Both. It violates that core assumption number 3. We talked about sustained competitive leadership and pricing power. That moat might not be as wide or deep as the market thinks.
So you put all that together, slowing physics, soaring costs, inventory signals, rising capex intensity, customer competition. What's the core danger for someone holding these stocks at current prices?
The core danger is simply that there is zero margin for error baked into these valuations. None. History shows us pretty clearly that in this sector, if things go wrong, maybe earnings miss consensus estimates by, say, 20%, which isn't uncommon in a slowdown.
What happens then?
A 30 to 40% correction in the stock price is not just possible, it's actually a plausible, historically consistent response. The error comes out of that Moore's Law premium very fast.
A 30–40% downside risk from current levels, that's significant. So for listeners watching this space, what are the key catalysts, the specific things to look for in the near term that might confirm this bear thesis is playing out?
Okay, two main things to watch closely. First, the upcoming Q4 2025 earnings reports. Listen very carefully to the guidance, especially from the foundries like TSMC, but also the equipment makers. Any explicit mention of inventory correction or softening demand, that's a huge red flag.
Got it. Q4 earnings guidance. And the second,
Keep a laser focus on AMD, specifically their ability to actually ship their next-gen MI400 AI accelerators in meaningful volume and on schedule. That 128x multiple is banking entirely on flawless execution there. Any hint of delays, yield problems, anything. That stock could re-rate violently downwards.
okay, watch inventory commentary in Q4 reports and watch AMD's MI400 execution. So wrapping this up, it really feels like we're at a crossroads. It boils down to a binary choice almost. Is this truly just the beginning, the early innings of a unique, multi-decade AI supercycle that rewrites all the old rules? Or is this maybe the most expensive, most crowded corner of a tech bubble that's set to deflate sharply once growth inevitably, normalizes?
Look, the AI story is powerful, the demand is real, but the data we've discussed, the hard physics, the runaway costs, the historical valuation context, the signs of inventory build, it all suggests that second scenario is frankly more probable right now.
More probable than the market thinks.
Much more probable. Valuations at these levels, they just leave zero room for the kind of uncertainty that always comes with major technology shifts. Moore's Law might be slowing down, but financial gravity, that's one law of physics that isn't changing.
A sobering thought. Moore's Law slowing, gravity isn't. We'll have to leave it there for this deep dive. See you all in the next ProTicker Deep Dive.